Hello friends, welcome to my YouTube channel Learning Together with Sakshi. Today our topic is Ind AS 110, which is relating to consolidation procedures, and within this Ind AS 110 today we will learn how to pass an elimination entries and carrying the same to subsequent year. Please note this is just a part 1 of my video. So let's start. Before learning how to pass an elimination entry, first we need to understand why there is a requirement to pass an elimination entry, why we want to pass the elimination entry. So if we see at a consolidation level, at a group level, if one company has sold goods to another company and we are consolidating the financials of both the company, so that uh, if I do 1 plus 1, so at consolidation level it will be like a duplicacy, it will lead to a duplicacy. So in consolidation level we will eliminate those intergroup transactions, so to get a fair picture. So in elimination what we will do, we will eliminate the effect of transactions that are between the group entities and also intergroup balances, intergroup transaction and unrealized profits. So let's start with an example. In my example, for example, entity A, which is a holding company, has sold goods to entity B, which is a subsidiary company. Okay, so for example, A has sold goods to entity B for 10,000 rupees. So in the books of entity A, this 10,000 will be forming part of sales, and in the books of entity B, that 10,000 will be forming part of purchases. This is just a simple example. So while doing consolidation, what we will do, we will eliminate 10,000 from sales and 10,000 from purchase. So we will pass an entry where we will debit sales account by 10,000, debit it, and we will credit purchase account by 10,000, which is credit. So this way at consolidation level our sale will be reduced and our purchase will also get reduced by 10,000 each. This was just a simple example, example 1. Now take another example, example 2. Same same concept, entity A holding company, entity B subsidiary company. Entity A has charged a rent of 10,000 from entity B, and for entity B, since this is a under construction entity, so the entity B has capitalized that rent in CWIP for 10,000 rupees. So now at consolidation level what we will have to do, we will first reverse the rent income which is in the books of entity A. So for to reverse this I will debit interest rent income by 10,000 rupees and I will credit CWIP of entity B by 10,000 rupees, debit and credit. Okay, now this is the case of year 1, and in the year 1 we will also record an entry for deferred tax. Why deferred tax? Because if I see CWIP, so if I see book base of CWIP will be 0 because I have reversed 10,000 rupees. But if I see tax base, it is still 10,000. So there is a temporary difference of 10,000. And since over here tax base of an asset is more, it will lead to a DTA. So we will pass an example. Tax rate is 30%, for example. So a DTA of this into 30% will be recorded. So we'll pass an elimination and we will pass a console adjustment entry where we will say deferred tax asset debited by 3,000 rupees, debit, and deferred tax income by 3,000 rupees, credited, credit. So these two entries we will have to post in year 1. This is year 1. Now in year 2, we'll have to first bring all those adjustments which we posted in year 1. So what we will say, this rent income which was P&L in year 1, it will be carried forward as a part of retained earnings in year 2. Okay, and retained earnings will be debited by 10,000. CWIP will be credited by 10,000. This is just a broad forwarding entry. And similarly, this deferred tax asset, we will have to carry forward this adjustment as it is deferred tax asset, and this deferred tax income will be again form part of retained earnings. This will be 3,000. Now what happened in year 2, entity B, which was under construction, got operational during year 2. So whatever adjustment we have posted in CWIP, now we will have to transfer it into PP. So to do that, we will debit CWIP 10,000 and we will credit PP 10,000. And for example, if after 6 months, means in mid of the year 2, that entity became operational, so that entity must have charged depreciation on that, so we'll have to reverse that depreciation as well. So we'll pass an entry to reverse PP accumulated depreciation and depreciation expenses. Correct. And assuming life of 10 years, divide by 10, and since the depreciation of only half year must have been charged, so divide by 2, will reverse the depreciation which has been booked in the books of entity B. Okay, now again there will be an entry of deferred tax. Deferred tax. Now what will be the entry over here? We will have to compute PP, book base and tax base. Book base and tax base. So tax base will be this minus this, and book base in our case is 0. Again the same thing, this minus this, and DTA will be on this into 30%. Into 30%. So, and since the deferred tax of 3,000 was already booked, so we'll have to pass a differential entry for this. One second. This plus this 2850. So that means we'll have to reverse deferred tax asset by 150. Deferred tax asset by 150 and deferred tax expenses by 150. Okay, now in year 3 we'll have to again carry forward all those adjustments. So the same method, retain earnings, CWIP, everything, retain earnings, CWIP. Since the CWIP has already been reversed, we can either carry this entry as it is, or we can carry forward this entry on net basis. So on net basis, what will be the adjustment? Retain earnings, this minus this, minus deferred depreciation expenses plus this. So this will be part of retain earnings. In CWIP, we will say this minus this. So CWIP will be 0. In case of PP will be this minus this, and deferred tax asset will be this minus this. With this, our opening adjustment entries has been brought forward. So I hope you must have understood how we pass an elimination entries and what are the console adjustments, and how we carry forward elimination entry from year 1 to year 2. I hope you have learned something new. So bye bye. See you next time with another video. Thank you.